Good morning, Jags. This is Fahad. Today is Thursday, February 25th. Let's get started. So today I would like to cover this earnings report from MAXR Technology, symbol MAXR. This company reported earnings last night, and the stock is looking to gap higher slightly by about 4% in pre-market. And so let's dive in. Now, first of all, for those who do not know, MAXR Corporation was made a top pick in the Jaguar fourth quarter 2020 outlook. So basically, it was right around here when the stock was trading around $27, $28 per share. And then subsequently, it had a fantastic run for the rest of the year, late in 2020, and then it continued well into January as well before going into a new consolidation phase. I own the stock, as well as I believe a lot of Jag clients also own the stock, so it's important to provide some update on this. Now, there are two pieces to this puzzle. Both of these were discussed in the Jaguar quarterly outlook originally. The first one is the traditional business of putting more and more satellites in the orbit, and that's what this company does. And one of the things that we were noticing, which prompted my attention to get into this stock, is basically just a simple cyclical rebound in the satellite business. That's the first piece of the business. And so one of the charts that was presented in the quarterly outlook last year was this, in which we talked about how the commercial geo satellite orders, which had been coming down and down and down for a long period of time, because simply there was no need for it, and the industry growth had stalled essentially. Basically, we're seeing a sharp rebound. We hit a low point of 2018 of just 5 new satellites, geosatellites were put in space by this company, and then it had a sharp rebound in 2019. And when we presented the outlook, which was at the end of September last year, so year to date at that point, the company had already placed 18 of the satellites in the orbit. Well, now we have an update on this, and this is a brand new chart. This is for the full year now. It ended up rising from 18 to 26. So in the fourth quarter of last year, which was reported, the earnings report last night, the company put up another 8 satellites in the sky. And now if you look at this trajectory of the satellite order trend, you can see that how it crashed in 2017, hitting a low point there, and gradually has been trending higher and higher. I believe this will go even higher from here. And the reason for that is you have to dive in deep into the management discussion, and as well as what their highest customers are doing to understand exactly where the capex is moving. The company's biggest customers are Raytheon, Lockheed Martin, Northrop Grumman, General Dynamics, AeroVironment, and then also on the satellite side, on the private side of the business, is Intelsat, Viasat, Eutelsat, Iridium, Sirius, EchoStar, Orbicom, and Globalstar, and many other large customers. And then governments are also part of it. Management is very, very upbeat in the earnings call last night, as I read the entire transcript, that they continue to believe that this traditional business of putting more and more satellites in the sky will continue to see healthy level of growth going forward from here. In fact, this business grew by 43% year over year in the fourth quarter, which was reported last night. So that's the first piece of the puzzle. I expect this number to go up even more. The second one, and this is perhaps the most interesting one, is a massive and a very, very important launch that is coming up. And that is the primary bull case that was discussed in the Jaguar quarterly outlook, and is called right here, Worldview Legion Earth Observation Satellites, right here. Now, this launch was originally expected by mid-2021, so in just the next couple months, but it was pushed back because more capex was needed and some disruptions happened because of COVID last year. And management is telling us this morning in the conference call last night, which is right over here, on Legion, we remain on track for a September launch window for our first launch. And as I mentioned above, we already have $50 million of awards for 3D and recon products. Our second priority this year is to continue to establish a firm foundation of growth for space infrastructure. This means we'll be focused on driving diversified bookings so that we achieve our target goal of revenue mix of 1/3 commercial, 1/3 civil, and 1/3 military intelligence. to understand the significance of how important this launch is that is coming up in September, go to company's website and take a look at what this actually does. Right here is the company's website. There are a bunch of videos here, and you'll be shocked exactly the kind of cutting edge technology this is. This company, this Worldview launch is going to provide unprecedented visibility in the 3D format of the world. And basically, it's going to try to address a lot of the problems that cannot be solved today with the static technology that even the military doesn't have yet. There's a lot of videos over here how they collect the data in real time using combination of hundreds and thousands of satellites in the sky to create a 3D image of the world and provide real-time information and data that is just never possible before, going, for geological surveys as well as military use, as well as weather patterns to see, how the weather patterns are going to change over time, to see traffics, to see all kinds of things. It's really incredible science. There's a lot of videos that are on the company's website. So that is the significant. This particular product will allow the company to offer only 30 centimeter of imagery and boost MAXR's daily orbital revisit rate. The launch of Legion will also make MAXR's position robust relative to other bidders, not only for the large contract from the government that's called NRO contract for future projects, but also for the commercial use. And when you combine the geospatial analytics with the expertise that the company already has for the current imagery, because it puts up all these satellites in the sky, that's when you get some really, really fun business to come. Now, with all of this said, last year, when we issued the quarterly outlook, as of September, the company finished the quarters, that's the third quarter of 2020, with $1.6 billion in total backlog, revenue backlog. They finished then the fourth quarter, December 2020, which was reported last night, at $1.9 billion in revenue backlog. And in the earnings call last night, management said, all told, we see in excess of $25 billion in pipeline opportunities over the next 5 years, which compares quite favorably with the $1.9 billion of orders we booked this year. 1.9 billion versus 25 billion. How are they going to get there? They're going to get there with this launch that is expected sometime in September. This is that's why I love this stock, because this has a market capitalization of only right now $2.8 billion, and I think this is going to provide significant upside for steady, strong investors that are going to hold the positions and let this thing play out. You've got both the cyclical side going up with the commercial launches of satellites happening and this major launch coming with huge potential on the upside for the next couple of years to come. This could be a multi-bagger even from here, and that's why I continue to own the stock. That's it from me. Let's go to Jay.
Morning, everyone. Today highlighting a company called the Toro Company, ticker TTC. It's not a name we typically talk about, but this is an industrial equipment company. It's going to be reporting earnings next week on March 4th. If we take a look at their sales breakdown, 75% of their revenue comes from what's called the professional segment, and then the other 25% comes from the residential segment. Within the professional segment, this is where they offer turf and landscape equipment products, including sports field and ground maintenance equipment, golf course mowing and maintenance equipment, rental and specialty construction equipment, snow and ice management equipment, and then related parts and accessories for light and medium duty trucks. So first off, both Stanley Black & Decker and Generac have both recently spoken positively about the near-term demand outlook for outdoor power equipment on their earnings calls. So you have a positive read-through there. B of A was out on Tuesday with a note on Toro, basically highlighting some potential tailwinds you can expect. The first one was regarding golf. They note that historically, Toro's share price has shown a strong correlation with golf rounds played, and they are getting increasingly confident in another good year for golf as their consumer and leisure teams continue to note strong spending. On February 8th, B of A's consumer team noted that golf spending was up 27% year over year in January. And then if you look at a recent KeyBank note from this week, they took a look at data from Golf Data Tech, which showed that while January represents the seasonally lightest month of the year, industry hard good retail dollars grew at a robust 47.7%. And then they broke it down by, specific products like woods up 45.1%, irons up 56.8%, etc. So a positive read through into that industry. You then take a look at the weather, specifically the snow season. B of A notes that it had already been a very active snowfall season so far in many parts of the U.S., specifically in the Northeast, and then most recently Texas happened. So they speculate that the heavy snowfall this winter is going to bode well for its snow thrower business at the home centers and hardware stores, and for their Boss product line, which designs and sells snow plows and salt and sand spreaders. And then the final point to watch out for on the earnings call is, along with the mass power outages you saw in Texas, there were also reports of widespread problems with water infrastructure in the state as pipes burst and water treatment plants were saddled with outages. And so this is the type of situation that could provide a boost to Toro's underground construction equipment business in the event that digging is required to make these repairs. So I know B of A said that they're going to be looking to learn more on this when the company reports next week.
Sounds like a pretty exciting opportunity here. This is also a very nice technical setup.
Yep.
If you look at this is the very clean resistance level at $102 per share. It's attacked that level multiple times, and arguably this is a breakout setup over here. And most importantly, as you know, I love stocks when they're coming up to resistance on rising volume. And that's exactly what's been happening for the past 3 days. The volume has surged as the stock is coming up to this important resistance. So this is a breakout. This is also a cup and handle formation, rather a small one, but here's a cup and here's a handle. So a breakout from that should take the stock to $106 to $107 per share. And the catalyst may very well be this earnings report that comes out next week on March 4th before market opens. And so given this view that you just presented, I would imagine that they're going to talk about improving growth and maybe raise guidance materially for the second quarter. For the first quarter, it should be strong, and then also for the second quarter, given the Texas and all other news. So interesting one. I like it. All right, let's go to Chronicle.
Morning. There's a stock that's been on my watch list for a while on the bullish side, and yesterday I finally pulled the trigger. Company Steelcase, ticker SCS, which I believe was a short idea last year, which somewhat worked, though the returns weren't great. But now I think it's time to revisit it on the long side. So just as a refresher, this company makes all sorts of mid to higher end office furniture. They do have some exposure to other non-corporate settings like hospitals and schools, but the vast majority of their revenue comes from office furniture. First, taking a look at the quantitative side of things, we can see that revenue-wise, company was doing pretty well prior to the pandemic, considering it's not exactly a fast-growing industry. Now, take note that this is currently fiscal year 21, and fiscal year 22 is starting right about now. So this company's fiscal calendar is a bit different. So starting next month in March, we're going to be in FY22. So my bull case here is very simple. I think fiscal year 22 earnings and revenue estimates are too low because judging by the latest trends right now as we emerge from the pandemic, it's looking like many companies are either going to be fully bringing back everybody to the office, or they are implementing a system where the workers are coming back to the office on certain days of the week and then working from home remain in the remaining days. And this is for the US. Meanwhile, looking at Asia, which is just over 10% of Steelcase's revenue, what I'm observing here is despite temporarily allowing work from home, companies are generally still not willing to allow permanent or partial work from home after the pandemic. So it's looking like almost everybody is going to be returning to the office. This is not the first time we've had to deal with a pandemic. And what this means is that it's almost a guarantee that the demand for office-related products is going to recover faster in this part of the world than in North America. But coming back to the US, so even under a scenario where the workers are going to come in on some days of the week, and then that means offices are still going to need furniture. And I think right about now is when companies are going to start investing and getting their office spaces ready for the anticipated return of their employees. So is demand going to reach peak 2019 levels? Probably not, but I do expect the revenue to be coming in better than what consensus is forecasting right now. I really don't have any channel checks. I really don't need any channel checks to tell me demand for office furniture this year is going to be significantly better than last year. And in the latest conference call, even the company's management said that most of their biggest customers are planning to return to the office this summer, and some of them were already beginning to restart activities as early as December. So I guess what I'm saying is, even though I don't have any sell side research or channel checks right now, I'm actually perfectly fine with getting long the stock and front running the consensus here right here right now. I'm going to be targeting $18.50 over the next couple of quarters, and the next earnings report is still some way out in late March.
You know, this is very interesting because this is exactly the kind of out of box thinking from a view that is completely being avoided in the market for quite some time, which basically performs a significant amount of upside and the beta and alpha generation in portfolios. And let me give you some of my high qualitative thoughts. This view out there that these places like New York City and LA and and all the major towns are going to become permanent ghost towns with nobody ever returning is really stupid. It's not going to happen. I don't doubt that some jobs have permanently shifted to work from home, but the population is always increasing by 1.5% every year. Arguably, it's probably accelerating now with everybody sitting at home. And then secondly, people are going to return back to work. New office space was always be needed, and it's always being created just to factor in the population growth, and job creation is going to be there. And as a result, these towns are major mega cities are not going to become ghost towns. You will see improving mobility everywhere. And people frankly want to be back in the office. Nobody wants to continue to sit at home all day long. And so with all of this said, there is going to be a demand surge. It may be lumpy at times, and it's going to be difficult to forecast because we don't quite know the mix between how many jobs will be returning back to the office and how many won't. But nonetheless, it's going to be an improvement, sequential improvement quarter over quarter. While these stocks are so depressed, Steelcase being one of them, that the benefit will be there. It's just hard to quantify exactly as to how much. And if we get to a 6% GDP print in the United States, which I actually expect it's going to happen this year, 6% GDP growth, which we haven't seen since 1980s, and the vaccines causes basically herd immunity by summer months with 70-80% of the population vaccinated, you don't have a bear case around COVID anymore at all. It's life fully back to normal at that point. So I like this play. I think this will continue to gradually move higher. $17, $18 per share should be the area where it should go over the course of next couple months to couple quarters. Great stuff. All right, gents, we're going to stop over here. Thank you very much for joining. We'll see you in the chat room shortly.